Good day, everybody, and welcome to Lesson 4 in the Ben and Boz Narrated PowerPoint series. I'm Boz.
I'm Ben.
How you doing today, man?
It's a beautiful day.
It is awesome. I'm excited to get into Lesson 4 here. I think I'm going to let you take the lead. You can play by play it. I'll do a little color.
I'm excited to jump into it. Let's do it.
Do it, man.
All right, everyone. Today we are doing Financial Accounting Lesson 4, Completing the Accounting Cycle. So before we even get into any of our specific objectives for the day, let's start with a little example. So Boz, what we got here is Salesforce's income statement and balance sheet. So Salesforce, you know what they do at all?
Is that cloud stuff?
Yeah, cloud stuff. Customer resource management is their biggest thing. So anytime companies are looking to get more information about their customers, they can use Salesforce with their cloud services. So we have the balance sheet, income statement here, and one of the major things we're going to do is adjusting entries.
Sure.
Which of these accounts do you think need adjusting entries at period end?
You know, when I think of adjusting entries, I think of, we're going to talk about them, but accrued revenues. So I'm going to be looking at, revenue type of accounts. I think about accrued expenses. So I'll be thinking about some of my current liabilities, maybe some debt accounts. I think about deferred revenues as well. So if there's any unearned revenue accounts, I think about deferred expenses as well. So stuff like depreciation and prepaids, things of that nature. How'd I do?
Right. You did pretty well, actually. So
Okay.
You nailed all the revenues and expenses. And one thing I do want to point out, which we'll see as we get going here, is that every time we adjust one of those revenues or expenses, we're going to also adjust something on the balance sheet as well. So here you go. I just highlighted in red here. These are some of the balance sheet accounts that we'll talk about adjusting. Property and equipment, depreciation, you talked about that. Prepaid expenses, rent, insurance, things like that. Accounts receivable, that goes with revenue. Unearned revenue, accounts payable, maybe wages expense, things like that.
This is a nice financial statements. You found a good example with this company. A lot of them don't go into this level of detail.
Do you know how I found it?
I don't.
I went ahead and Googled companies that show honored revenue
Seriously?
on their financial statements.
That's awesome.
And
that's cool.
actually, interesting thing I learned, a lot of service-oriented companies, they'll charge for their service up front, so they'll have some significant unearned revenue on their balance
Makes
sheets.
sense. A lot of times they're selling them subscriptions a year at a time or something like that.
Yeah,
but
cool. Good. And then on the income statement, revenues, general and admin expenses, interest expense. Here's where we don't see as much of a breakout. For example, depreciation expense might be included in.
There's a lot in that general and administrative expense line, so there's piles of accounts in there.
Yeah. So hopefully that was a good little hook for you guys.
I loved it personally, so
good.
It's good.
Good.
Yeah. I'm happy.
Some of our objectives today. First thing, learn how to create an unadjusted trial balance based on the T accounts. Up to this point, you've been recording journal entries and putting things into T accounts. But now we're going to take the next step out of those T accounts. Then understand and apply the 4 types of adjusting journal entries. We'll go through some nice examples for you. Third, understand how to create the adjusted trial balance and the financial statements. Basically, we're going to take that unadjusted and change it for all the adjusting entries that we make. And then finally, we're going to finish up with my personal favorite, understanding how and why a company completes closing entries.
You love closing entries, so
you kind of wipe the slate clean.
Do.
You get to start over for the next
start
one.
fresh. I like it.
Celebrate all the successes you had and move on to the positive. So let's start with T accounts, the unadjusted trial balance. First up, T accounts. This is just a really simplified version.
Sample company here. So,
exactly. Kind of relates to Salesforce, not completely, but sample company.
Loosely inspired by Salesforce.
Loosely inspired. You're a pro.
I'm older, that's my wisdom. So,
well, it's
whatever.
something.
It's something. So,
all right. So, when we have our unadjusted trial balance, all we do is take each of these T accounts, arrange them just right here, like you can see in a list, top to bottom. You see, there's no titles like assets, liabilities, revenues, expenses. We don't segregate like that. We just top to bottom, usually in order of account number, and then drop in the debit and credit balance before at the bottom we sum it up to make sure that every debits do equal our credits.
Yeah, that's kind of like a chart of accounts, as well. And as well, it's the unadjusted trial balance, but it's using their chart of accounts. And most companies do have in their chart of accounts, it's first assets, then liabilities, then equity, then revenue, then expenses. So it's in that order. I'm also proud of you, man. It balances. Great job.
Whew. Ben Trinka, CPA.
That's right.
At your service.
At your service.
All right. So let's get into talking about our adjusting entries. What you see on your screen right now is just a very basic timeline, really generic to help illustrate a point where we have the beginning of the month, our services provided are received in the middle of the month, and then we have the end of the month. Mm-hmm. So the first one I want to talk about is if we as a company provide a service in the middle of the month or receive a service in the middle of the month, but we don't actually pay for it or receive cash until afterwards, that's called an accrual.
Yep. So we have the service comes before cash. That's the accrual. The event mm-hmm. comes before the cash. Mm-hmm. That's accrual.
The way I like to remember this, if you're just trying to remember the technical terms, accrual is cash later, ACL. You all have ACLs, right? So accrual is cash later.
Wow, I'd never heard that.
I just made it up. It's a Ben Trinka special.
That's awesome. So,
do you have any way to remember it?
No. Yeah. I can't top that one.
An ACL doesn't really relate to accounting, but maybe you'll remember it now because it's a little bit weird.
All right.
Yeah. All right. Moving on. Now, sometimes as a business, they're going to have to pay the cash before the service is provided, or before, they receive the cash before a service is provided, mm-hmm. or they'd have to pay the cash before the service is received. Mm-hmm. And if that's the case, we're going to be on the left side of our timeline here in a deferral position.
We would be deferring the revenue or expense. The cash is coming first. Defer it later.
Exactly. And so, as Boz talked about earlier, we have accruals and deferrals that can be either revenues or expenses. So, two main types, accruals, deferrals, and an accrual can be a revenue or an expense, and a deferral can be a revenue or expense. So total then, we have 4 different types that we're going to go through. Accrued revenue, deferred revenue, accrued expense, and deferred expense.
Yeah, and just maybe a point about this. So a company has gone throughout its the month, the quarter, the year. They've done all their regular journal entries. They've created that unadjusted trial balance. And then now they're making these adjusting entries, and that's usually going on for the week or 2 after the end of each accounting period. And so that's a really busy time for the accountants. And I would say this is probably the most complex stuff. They really have to dig in and gather some facts. And so this is when accountants get really busy, really earn their money after the end of the periods.
Yeah, no, that is totally true. And a lot of times these are really non-standard entries sometimes. Mm-hmm, so some of them are like interest expense, mm-hmm. but a lot of them are very non-standard. So it's trying to figure out what kind of support do you have, or even in more advanced levels making some estimates. So,
Exactly.
Yeah.
So let's get into the first one.
You ready for some examples?
I bet it's going to be accrued revenue.
We'll
hope it is.
We'll see. Look at that. Accrued revenue. So just as an example up here, our service is going to be provided sometime before cash is received. That's why we just brought this into this slide here. So you see the service is going to be provided, and then as a business, we are going to receive the cash later.
And we taught them in lesson 3 that you record revenue at the time you deliver goods or perform the service, not when cash is received. So that's why this distinction is important up there.
All right. So the example we use, Salesforce provides $1,000 worth of support services, so customer resource management services, to a client during the month, but they don't receive payment until after the end of the year. So what is the journal entry going to be on December 31st? That's ultimately where we're going to go. So as of December 31st, do you want to take the lead on this one, or you want me to?
I could just do it. So I look at this one, and then as of December 31st, the company needs to accrue the revenue here, right? So we know we need some revenue, but it's not like we got paid for it at the time. So we're not going to debit cash and credit accrued revenue. We're going to credit our revenue account, but instead of debiting cash, we didn't get it. We're going to debit accounts receivable. Someone owes us some money. So debit the accounts receivable, which is an asset. Someone owes us something, and then credit our revenue account. Wow, awesome.
Way to go, Boz.
I'm happy. So,
Boz Bostrom, CPA, everyone. All right, so then one more, just to take it to the next step. What do we actually do when we do finally get paid for these services? And at that point, we don't want to record revenue again because we already recorded that once. So we're going to have some cash coming in the door. So we're going to debit our cash, increase an asset for $1,000. But instead of crediting revenue, we are going to credit that accounts receivable, because after someone pays us, we no longer have anything coming from them. There shouldn't be any more of a receivable. So by crediting that, we're going to decrease the asset.
Exactly.
So debit cash for $1,000, credit accounts receivable for $1,000. And if you kind of look at this almost in a net method, the accounts receivable was debited and credited. They end up canceling out, and cash is going to be increased and revenue is going to be increased.
I look at accounts receivable as a temporary account kind of with respect to this one. And you look at this, if you sent the customer a bill after you recorded the services, an invoice, at that point in time, you might do that first journal entry, accounts receivable and revenue. But if you don't, you get to the end of the accounting period, maybe the people in charge of sending the bills, the accounts receivable folks, if they didn't send it, the revenue is earned that period, so you got to record it that period.
Yeah, absolutely. It's right here in this example, it's pretty easy to see. It does get a little bit more complicated in some businesses. As an example, one of the companies I used to audit was a trucking company, and at the end of the year, they would have to make an estimate for their revenue amounts, because a lot of times the truckers would complete certain loads, but they wouldn't send in all the paperwork. And so there'd be some loads outstanding where they haven't received all the details and know the exact revenue. So they'd have to kind of make a guess for accounts receivable and revenue.
You could talk about that like in lesson 48. So
lesson 48,
deep,
advanced auditing.
That's right.
Let's move on.
All right, deferred revenue.
Right, deferred revenue. So as you see on the top of the screen here, in a deferred revenue situation, a customer is going to pay the business up front. So we're going to receive the cash first and then provide service later on in the month or afterwards. And Salesforce actually has quite a bit of this, and so we're going to use them for an example here. On the first of the month, they received payment from a client for $1,000 for cloud services starting on the 15th of the month. So what is the journal entry on the first and at the end of the month after the services have been provided? Can I take this one, boss?
Go ahead. You seem excited.
I am pretty excited.
Okay.
I mean, I like it when I get paid early. That usually is a business. That's a good thing, right?
Yep.
So at the time, on the first of the month, at the time I receive the cash or the check or whatever it is, I have to debit my cash because they got me the cash, right? So debit an asset for cash. We'll increase it that way. And then the credit, this does trip students up quite a bit. The credit actually goes to unearned revenue, which is a liability account. So we're going to credit unearned revenue for $1,000 by increasing that liability.
Yeah, the concept is you haven't earned it yet, right? As the first of the month, they've got the cash, but they owe people at that point in time for some services they're going to provide later. And if they don't, until they provide those services, they have an obligation to their clients. If they didn't, the clients would ask for the money back. So they have not earned that revenue until they provide the services.
And they still, if you want to take it the other way, they still owe them those services. Liability is something that you owe. In this case, a lot of times it's cash, but in this case, you owe the service.
Owe that obligation to provide services.
But then at the end of the month here, you've actually provided the services, they've used it. Now we don't owe them anything. So we can get rid of that liability by debiting unearned revenue for $1,000. And at this point, we've earned it, we've provided the service, we've done the work, so we get to credit revenue for $1,000, which is going to increase our revenue. Boom, there you go.
Temporary account, unearned revenue, set it up until you've actually earned the revenue. You know, an example of this one that I think on is probably like Amazon Prime. And I'm not sure what the fee is for Prime. I know it's going up. Maybe it's $119 or something like that. I think
that's what it's going up to, I want to say.
You know, but when they do that, they're going to be, when I make my Prime payment, they're going to debit cash and credit unearned revenue. And it's just each month as they, give me the benefits of Amazon Prime, they'll record revenue on a monthly basis for that one. They can't record it all up front.
That is an outstanding example.
I just came up with it right now. I'm pretty proud. So thanks for the affirmation.
Way to go, boss.
Thanks, sir.
I can't top it, so I'm going to move on.
You're going to move on. Accrued expenses.
All right, accrued expenses. So in this case, the example that we're going to use is employees doing some work for us. We haven't paid them yet. But anytime we have an accrued expense, we as a business have incurred some type of expense, and we haven't necessarily paid the cash yet for that expense. And so as a result, at the end of the period, we have to record the expense and a related liability.
Do we want to match the expenses to the revenues?
Exactly. Even though cash hasn't gone out the door yet, we still have to record that.
Yep.
So in this example, Salesforce pays the employees every 10 business days or 2 weeks. At the end of the month, employees were owed for 7 days of work or $7,000. Payday wouldn't be until day 10, and so you still have 3 more days they need to work before you pay them, but they have done the first 7 days. So what's the journal entry at the end of the year, and what's the journal entry when employees are paid?
Is that for me? You want me to take this one?
I'm asking you, Boz.
Sure. I'll give it
Boz
my best shot
his hand
here.
right now. You can't see him.
So, at this point in time, I've got an expense. All right, I've got my employees. They were working during that period. They were helping to generate revenues during that period. So I want to match that cost of the employee to the revenue. I'm not going to pay them until next period, but I want the expense in this current period because that's when they were doing the work for me. So again, I need the expense. I'm going to debit the expense. I'm going to call it a wages expense. But I haven't paid them, so I can't credit cash. So I am going to credit a wages payable account is what I'm going to do because I have an obligation to my employees. And then at the start of the next period, so go ahead. Yeah,
you
wages.
crushed it. Just so you know.
I crushed it. I appreciate it.
Debit wages expense, credit wages payable for $7,000.
Well, thank you.
Well done.
Yeah. And then let's say next period they work the extra 3 days in the period. So they work 3 more days next period, and then we pay them. Well, when we pay them, then we're going to be paying them for 7 days they worked last period and 3 days they worked this period. So we're going to be paying them for 10 days, but we don't do all 10 days of expense in this period because we already recorded 7 days of expense last period, only 3 days of expense this period. So when we pay them for the 10 days this period, we are going to debit wages expense for the 3 days that we owe them money for this period, which will be $3,000. We're going to get rid of that payable, debit the wages payable for $7,000. We're no longer going to owe our employees after we pay them, and then we're going to credit cash for the total $10,000.
There, final answer?
Final answer.
Locking it in. There you go. Look at that. Exactly right, boss. Perfect. Shocking. This is actually very typical type of entry that companies make, usually with wages for sure, for a lot of even salaried employees, where you can figure out the number of days that they've worked, and you have to accrue for that by recording an accrued expense.
Some employees are paid, for example, on the 15th of every month and the last day of every month. Then you really wouldn't need this. But we, as an example, Ben, you and me here, paid by the colleges, we are paid every 2 weeks. So are we paid? I don't even know when I get paid.
We used to be paid every 2 weeks. Now it's the 15th.
I don't even know. So that we do not see an accrual for us.
I wasn't even going to say anything about it. I'm just going to let it go.
It's a good example.
I'm just going to let it go.
So this doesn't happen at our college for us.
It does not.
But for people that are paid every 2 weeks, totally.
Exactly. My wife gets paid every 2 weeks.
So it happens for
to her.
Yeah, gotcha.
There we go.
Yeah.
All right. So last example here then for adjusting entries, we have deferred expenses where at this point we are paying cash up front for a type of service or good or whatever it is, and then we're not actually receiving that good or service until later on in the period.
We are going to defer the expense. We're not going to use it until later.
Oh, deferred expenses, we can defer that's kind of like accrual is cash later, ACL. Deferred expenses, we're going to defer the expense.
Yeah, that's better than ACL. All right.
So what Boz came up with. Deferred expense means we're going to defer the expense. Anyway.
What's the example?
The example. Salesforce is paying rent 6 months in advance. I don't know if this is true. I just made it up for this example.
They could, totally. Sure.
Total rent paid for the 6 months is $6,000. So we got $1,000 per month.
Good math.
And we want to figure out what is the entry when payment is made and what is the entry after the end of 1 month.
Mm-hmm.
So in this case, right away when we make that payment, we have to credit our cash for $6,000 because we know that's going out the door. And I'm actually going to debit an asset account, prepaid rent.
Yeah. The most common wrong answer would just be to debit the rent expense when that one was paid. But the expense implies you kind of have used up an asset. We haven't used up this asset yet. We've got, I don't want to say free rent for the next 6 months, you know what I mean? But we've got a facility that we can use for the next 6 months without making any more payments.
If you remember way back, I think it's lesson 2, was it? Where we were talking about defining an asset and what that actually meant. And an asset was something that was going to provide a benefit to us down the road. Well, in this case, we paid early and we get the benefit of that rent for the next 6 months.
Yep.
So at the end of the 1 month, then we've used up 1 month worth of that benefit, our $1,000. So we should credit our asset because we used it up. So credit prepaid rent for $1,000 to reduce it. And then we are going to debit rent expense for $1,000 because we have incurred that expense. So now we should record it.
Yeah, one thing to notice, we normally put debits before credits, right? But Ben talked with both of these journal entries, the credit before the debit. And that's just sometimes because it's more logical sometimes to think the credit's maybe more the logical one. So you start with that one and then you figure out what the debit is after that. So you list the debit first, but sometimes you think of the credit first if it's easier for you.
Yeah. Do whatever works as long as you get the right journal entry at the end.
That's about it.
All right. Do you think we should move past adjusting entries?
I personally, I'd like one more. It's almost like if you could have created a bonus.
Bonus deferred expense. That's going to be great. So
That's awful.
A lot of times with deferred expenses, a pretty common one that you see is interest expense, and we don't want to feel that we're cheating you guys out of that interest expense. So in this example, Salesforce takes out a 1-year, $1 million loan on July 1st. The loan has an 8% interest rate, and interest payments are due each year on June 30th.
I guess if it's a 1-year loan, we'll just say they're due at the end of the first year at June 30th there.
Yep. So what is the journal entry related to interest on 12/31, and what is the journal entry on 6/30 of year 2? So before we even get to 12/31, why don't we record that initial journal entry first?
Sure.
On 7/1 when we took it out. Mm-hmm. You want me to try this one?
I tell you what, how about you debit? What are you gonna do? Debit cash here? I can do that part.
We received the cash, right? So we're gonna debit cash.
I can figure out that.
And I'm gonna credit notes payable.
Notes payable.
Yeah,
not an account payable.
No, I'm gonna use notes payable. This is gonna be a lot more formal. Probably some signed documents going back and forth, defined repayment terms. I'm gonna use a note payable.
Yeah. A lot of times people confuse notes payable and accounts payable. I usually think of accounts payable. You're just purchasing stuff in the ordinary course of your business, promising to pay off your suppliers later. Notes payable doesn't happen as often. Oftentimes it gets paid off in installments. It's interest bearing.
Larger dollar amount a lot of times. Yeah.
Totally.
All right. And then now we're ready for 12/31. So at this point, December 31st, we've had the note for 6 months so far. Don't forget to count all of July because we got it on July 1st. So it's pretty easy to skip over July and just start counting with August.
I won't forget.
Thank you. So we have it all of July. It's December 31st, and now we need to record interest expense because that $1 million loan has been accumulating interest this whole time. So to do that, we are going to debit our interest expense and credit our interest payable. To figure out the amount, we're going to take the $1 million that we owe times 8%, because that's our interest rate.
That's an annual interest rate.
Exactly, annual rate, and it's been 6 months. So in an annual period, there's 12 months. 6 have gone by, so I multiply it by 6/12. Yes, I know 6/12 is 1/2, but I always like to put it in terms of months just to keep it consistent every time when I'm thinking through it.
Absolutely.
Yeah. So if I do that, it comes out to $40,000. And my debit is interest expense for $40,000 and interest payable for $40,000.
Yep, you got $1 million times 8% times 6/12 is where we're at. Yep.
All right, so now the last one is 6/30, year 2. We're going to go ahead and pay that one back now. So first of all, we have to pay back the entire amount we borrowed.
So we're going to debit notes payable, credit cash for $1 million, and we're done.
Are we done though?
Oh, did I jump the gun?
You did jump the gun.
Okay.
You got half of it right though, Boz. Partial credit.
Thank you.
You're going to debit notes payable for $1 million.
I like partial credit.
But if you remember from 12/31, we got this interest payable sitting out here for $40,000.
Okay.
And so we don't want to leave that on our balance sheet forever. So we're going to go ahead and debit interest payable for $40,000 to get rid of that. Right. So right now, notes payable, debit for $1 million. Interest payable, debit for $40,000. Both of those are gone. One more thing that we need to do, that interest payable, that was for our interest expense through the first 6 months. Well, we had it for an extra 6 months, so we need to record additional interest expense for those 6 months. So we're going to debit interest expense for $40,000, and we're paying it all off right now. So one credit, add those 3 numbers up. It's going to be a credit to cash for $1,080,000.
Yep. So yeah, makes sense. So that's the $1,080,000, that's $1 million that we borrowed, and then we basically paid 8% because the loan was outstanding for a whole year. So the total interest that we pay on this note is $80,000. But a common mistake would be someone would just forget that adjusting entry, and they would try to just make the entry on June 30th, where they would just record all the interest expense in year 2. But we can't do that because we had borrowed it for the whole year. So we need to split that interest expense to the years that it related to, the periods it related to.
Yeah, exactly right. All right, no more bonus questions. Let's move on to the next step. So in our business now, we had an unadjusted trial balance that we showed you. And what you see on the screen right now is all of the little adjustments that we made. So we debited accounts receivable, credited prepaid rent, all of that.
They could pause the video and track them all through, or just take our word for it.
I think you can trust us, but actually probably pretty good practice for you to do it on your own.
Follow each one through.
Yes. Yep. So then what we do is take our unadjusted trial balance that we had before. record all the adjustments right next to it. You see accounts receivable, we debited for $1,000, just like we had in our T account here. And then we create an adjusted trial balance by taking all the amounts we had initially and then adding or subtracting the adjustment based on whatever is appropriate. So accounts receivable, we started with a debit balance of $12,000, then we added $1,000 to the debit to come up with a total debit balance of $13,000.
Do it again. We're going to cut. So those are all of the adjustments except for the bonus one. We didn't put the interest was just to kind of just for it was just bonus. So these are the first 4 adjusting entries in here. So all right, so we go from the unadjusted through the adjustments to the adjusted trial balance, but it still balances, which is good. And well, now what do we do with it?
Well, now we get to the fun part where we create our financial statements. And those financial statements, again, they allow us to summarize everything that happened during the year in just a few sheets of paper, really. Mm-hmm. And we're able to evaluate our overall results, see what happened. So, nice. First one that you usually create from your adjusted trial balance is the income statement. As you see, we had revenue of $38,000 and then expenses for wages of $24,000 and rent of $12,000. So total, we had operating income of $2,000 here.
Yeah. We're simplifying it. We don't have income taxes in here, so it's just keeping it simple for now.
You would mention taxes.
Well, I know. I'm just a tax guy, Yeah, so I prefer it this way. It's simpler.
If you got a tax question, boss is your guy.
Well, thank you. Thank you for the shout out.
Yeah, shout out, not an advertisement.
That's right.
All right. So after we create our income statement, then we can do our statement of changes in stockholders' equity. We didn't put any common stock in here, just to, again, make it a pretty simple example. But we start with our beginning retained earnings, add the net income that we just calculated up above from operating income to get us a new ending retained earnings of $10,000.
Yep. And again, we go from the income statement to the statement of changes in stockholders' equity because we needed to plug net income in there. And now that we've done that, we have retained earnings. So now we can go to the balance sheet. Now that we know what our ending retained earnings are.
There we go. So we got the balance sheet. You can see our ending retained earnings of $10,000 is updated to the ending retained earnings here of $10,000. Otherwise, all these accounts just equal to exactly what we had in the adjusted trial balance.
Sweet. We got financials. We done?
Of course we're not done. We got my favorite part, which
is
the
closing entries.
I think you're a bigger dork than I am. I want to say that.
Tied dork.
All right, it's a tie. Mm-hmm. So this is actually just a blown up example of what you had in PowerPoint lesson number 3, where we had retained earnings breaking out into expenses and revenues. So when we do our closing entries, we are going to take all of our revenues, put them into retained earnings, take all our expenses, put them into retained earnings, and ultimately revenues and expenses are going to have a zero balance. And all of that will be in retained earnings for our books. Everything will be wiped clean, ready to go for the next period.
We do this because the balance sheet is a point in time, whereas the revenue or income statement accounts are for a period of time. Walmart had $500 billion of revenues last year, but when they start the very next year, they have zero of revenues until the stores open on that day one. So they got to close out these accounts so they start with zero. Absolutely. But it's not like you close out cash. Your cash doesn't go away at the end of the year unless you give it to Ben and me.
If you want to, we're accepting. And so one last thing before we get into the example here. You see on the screen, revenues have a credit balance, and you know that by now. So in order to close them out, we're going to have to debit our revenues and then credit retained earnings, which, as you see, will increase retained earnings. And expenses are the exact opposite. With that normal debit balance, we're going to go ahead and credit expenses in order to basically get it down to zero, which means we have to debit retained earnings to decrease our retained earnings.
We do. Do you have an example to show them that even, maybe?
Oh, of course. Look at this. So total revenue for the company we just had was $38,000, and we had 2 expenses, wages expense for $24,000 and rent for $12,000. So we need to figure out the closing entries.
Mm-hmm. We usually close them out separately, like close out revenues first, probably.
Yeah, let's close out revenues first.
So if revenues has a credit balance, we just debit revenues to close it out, and then credit right to retained earnings.
There you go, and then credit right to retained earnings.
Sorry to steal your thunder on that. I know you like the closing entries.
You know, I'm glad to bring you in on this process. Maybe you'll start to love it too.
That's true, but I'm going to let you do expenses. I don't want to take it all.
So next out, number 2, we close out the expenses. And in this case, we are going to credit our wages expense and our rent expense to get those down to zero, which means our debit has to be retained earnings. So debit retained earnings, credit wages expense for $12,000, and credit rent expense for $12,000.
And if you just look at that, we're increasing retained earnings between those two entries by $2,000. We got a credit of $38,000, a debit of $36,000. That's an increase of $2,000. That's our income. So now retained earnings will have gone up by $2,000 because of our income for that year.
That's got to be a coincidence.
No, it's not a coincidence.
It happens like that every time.
Every time, man.
Every time.
Every time.
There you
That's
go.
why closing entries, you like them so much, I guess.
It all fits together. Big picture.
Yeah.
Speaking of big picture, now we have our post-closing trial balance, last document in this process here. We had the adjusted trial balance, and what you see on this post-closing trial balance is that revenues and expenses are down to zero. These accounts are all balance sheet accounts that have a balance, meaning we are going to start our new year with zero revenue and zero expense.
Exactly.
All right. All right, finish up here some key takeaways in this process. We went through a lot of different statements, but it starts with the unadjusted trial balance. Then you do those adjusting entries to create your adjusted trial balance. That leads you then to create the financial statements, starting with the income statement, then statement of changes in stockholders' equity, and ending with the balance sheet. And then finally, we finish after our closing entries with a post-closing trial balance. The adjusting entries, we went through 4 different types. They're a little bit tricky, right? So it might take a little practice before you get used to them, but accrued revenues, deferred revenues, accrued expenses, deferred expenses, those are the 4 types. If you know how to do each one, you can figure out pretty much any adjusting entry.
Yep, use the framework, apply it to any concepts there.
And then finally, best for last, I think we can say, closing entries are completed at the end of each period where we're going to debit our revenues and credit our expenses with the balance going into retained earnings.
Well, this was awesome. You know, the first 4 lessons are really the framework for financial accounting and the whole cycle. You have an idea of kind of how to do, I don't want to say everything, but everything is going to build off of this. When we come back to lesson 5, we're going to be digging into more detail now into some of these accounts. For example, lesson 5, we're going to be digging into detail with sales and accounts receivable. Those will be a couple of them.
It's a great preview, boss.
Well, hopefully they tune back in, man. I know I will.
Me too. Thanks for tuning in, everyone.
Cheers.